Hi everybody and welcome to the 333 Premia webinar of HDFC Securities. I'm Payal Pandya from the Investment Advisory team, and the subject today for discussion is life insurance, ULIPs versus mutual funds. And to discuss this interesting subject, we have Madhukar Ladha from the HSLI research team. Hi Madhukar, welcome.
Hi, Payal. Hi, everyone. Thanks for having me here.
Madhukar joins us with a 15 years of work experience tracking this sector and has been associated with HDFC Securities for almost 5 years in two separate stints. Madhukar, when it comes to life insurance industry, I was reading this report by IBEF where it mentions that life insurance industry is expected to grow at about 12 to 15% over the next 2 to 3 years, and that the private insurers market share is about 31% as of FY20. And the life insurance as such, the uh, is expected to reach about 35% of total savings towards the end of this year. So we definitely believe that life insurance is one segment of investment which is picking up. Now, uh, first of all, when we are comparing it with MFs,
Right.
what is our idea behind this comparison of ULIPs and mutual funds when actually the objective of the life insurance business and the AMC business is quite diverse?
Uh, so, okay, that's an interesting question. First, in the true sense, Indian life insurance is not uh, purely protection. There's a very large element of savings in it, right? Which then means that because the element of savings is so high, it becomes comparable to other saving products which are available in the market. And also, in fact, if you go on and if you look at the private life insurers, almost, I mean, 85 uh, 85 to 90% of their individual businesses are actually savings businesses, and the pure protection element for them is just about 10 to 15% in that range, which also is just picking up over FY20 and what we've seen in the first quarter of FY21. And the hope is that pure protection picks up over time because that's the more profitable element. But in today's scenario, most of life insurance is more savings, and hence it's more comparable to other savings products. Now, the second point is also that within the savings products, life insurers have this product called unit-linked insurance policies, which are ULIPs, which are even more comparable to mutual fund products, because over here what happens is that you're actually putting in money and you're awarded units, and how your policy does is a direct function of how well the fund manager manages that money, and it obviously additionally being a life insurance product also has a bit of an insurance element built into it. This hence, sort of the extension of this logic is that as investors, we want to then compare what how life insurance companies are then valued, because they have an AUM, and they have a savings AUM, and how much money do they make on that AUM versus what a mutual fund does. So that's the idea of basically trying to compare these two businesses, because essentially their savings AUM based, and both type of companies earn on those AUMs. Payal, I can't hear you. I can't hear you. Sorry.
Are you able to hear me now?
Yes, yes. Now.
Sorry.
Yeah.
So, while this gives us quite an understanding of why these two businesses can be compared, I also read somewhere that on the overall industry basis, the portion of non-linked insurance has actually increased from something like 59% in 2009 to 85% as of FY19. Now, this of course includes private and public, which is a different case as we see in case of private, which is like 50-50 contribution of linked and non-linked products.
Yes. Yes. Yes.
So how do you see this coming up in future? Is it that the linked products are likely set to go or grow, or is it the non-linked which are set to grow in future?
So, this will happen. So life insurance will be cyclical in times when interest rates actually you know uh, go low. That's the time when people will start preferring par products.
Hmm.
So right now, non-par and par sort of those products sort of pick up, uh, and as people want a certain share in par, gives them a bonus element in it. Non-par is more guaranteed, right?
Hmm.
So when markets are uncertain and money moves more towards non-par, once the market sort of stabilizes, and then you're going through an upswing in the beginning of that period, uh, uh, more par products are sold, and as people get more confident, people start buying in more ULIPs. So these are cycles which will typically come and go, right? And in general, having said this, uh, uh, Indian buyers of life insurance tend to buy more savings also, because Indians cannot sort of, and this is a hypothesis, that Indians always want return on their money. So if I'm giving you money, they can't digest the fact that I'll not get anything, and when hence
Hmm.
the propensity to actually buy pure term insurance is a lot lower, and you want to buy more savings products. Now, having said that, in general, what my expectation is that over a period of time, as people get more aware of life insurance and the need for life insurance, they will move towards buying more of pure protection products with a layer of term, with a layer of savings.
Hmm.
Uh, and the high penetration that we've seen in ULIPs should sort of gradually reduce over a period of time.
Okay. So, in case where we are comparing it with uh, the mutual funds, I read in your report that life insurance businesses, the financials do not show the exact profitability of the business, right? So,
Right.
and that is because they have high procurement costs. Now, most of these
Yeah.
private players, especially whether you consider it iPru or HDFC Life or whatever, they have their very strong banking counterparts. So does SBI Life.
Right.
With such vast distribution network, which is already established for a sizable number of years and widespread across geographically as well, what exactly causes such high costs of procurement?
So life insurers, the way the business works is typically for any policy which is getting sold. life insurance, and because the duration of a policy is quite large, it's almost, it can go on to 10 to 15 years, and some cases even more than that.
Hmm.
You have you pay high commissions to your agents or your banker channel partners. So that is one of the biggest elements of high costs for a life insurer on a life insurer's balance sheet. So obviously, I say iPru or SBI Life or HDFC Life, they pay commission to their banker partners, which essentially becomes an income line item for HDFC Securities or for HDFC Bank or any of these other companies. So that's mainly that's a big element. Plus, I think also within their costs, uh, your direct sales costs are extremely high in the P&L. So what happens is that these costs are paid upfront for the acquisition of the business, and it's not and they're not amortized over the life of the policy. They're
Hmm.
expensed right at time zero when they're buying when the policy is being sold. What that means is that the profitability on at in year one plummets,
Hmm.
and if year over year, if you keep growing that business, then your profitability never shows, because every year you're writing more and more business, and your upfront acquisition costs keep increasing year over year, and they keep profits depressed. Only in the later part, as time goes by, after 3 4 years, will after actually typically two 2 years to 3 years, will the life insurance on a single policy basis will start showing profits on the books of accounts. Hence, what happens is, if you just directly compare the profit number for insurance companies, it doesn't work that in that way.
Hmm.
This is sort of a specific problem as far as the Indian accounting standards are there. Uh, yeah, so that sort of causes a problem in foreign countries. uh, you are allowed to amortize these expenses, so there you'll see the profitability is a little bit more streamlined. And until the new IFRS accounting standard becomes applicable in India also, this will be the
Hmm.
case. It will take probably a couple of years for the new accounting standard to come online, and then the true profits will come in the financial statements as well. Until then, we have to live with some of these obscure, uh, definitions and
Okay.
do other ways to sort of find out the profitability of these businesses. Yeah, yeah.
Okay.
Sorry.
So also trying to understand that uh, from one of the tables in your report, I could understand that over, say, for example, a decade, okay, if so long as the new business premium is growing, which means the insurance company is acquiring a lot of new business, the costs are high and effectively there is operating loss. And in the years where there is not much of incremental new business premium, as compared to the previous year, it has been able to reduce the losses and come back to profit levels and things like that. So is this the kind of cycle that you were referring to a while ago?
Yes, this is
So,
purely because
and
of what I said. It's purely
hmm,
because of what I said, that you pay a high upfront cost, and that keeps depressing your profitability. Uh, as soon as if you start writing lower business, your book
hmm,
profits grow in those years. Uh, but that does not really mean that that's not really good. I mean, you want the
hmm,
business to grow and you want the profitability to come through. So the
correct. I was
accounting
coming
profits
at
are
that.
not, yeah, so the accounting profits are not really reflective of the true profitability of that business. So that's what makes it a little complicated. And then we have to carry out a certain amount of adjustments to sort of come to some sort of an estimated number of profitability, which we've done in our report. So if so, I can jump to that part and talk a little
Please
bit
go
about
ahead.
what sort of adjustments we've done. So as I was saying, that the commission costs are really very high, and commission costs are basically on two types: the first year commission and uh, single premium policy commissions, and then you have renewal commissions. Renewal commissions are more sort of recurring sort of expenses, so which those we don't need to adjust. But the single commission on single premium policies and the first year premium life insurance companies are allowed to pay a very high amount of commission on the first year premium. So, this element of commission that needs to be amortized over a period of or over the life of the policy. So, on an average, we've considered about 7 years to be the average life of the policy, and we've used that. We've amortized the commissions based on that. The other thing, even the OPEX that the life insurance policies incur, we've assumed about 75% of that OPEX to be upfront acquisition costs, and we've amortized that over the term of the policy. Then the other difference which we see between ULIPs and mutual funds is that ULIPs actually have give you some sort of protection, right? So there is an insurance element of there, which mutual funds do not actually provide you any insurance element. So
Correct.
so what do we do about that? One is for ULIPs, okay. For ULIPs, there is a mortality premium element. So roughly rupees 3 per 1,000 rupees is the mortality premium that typically life insurance companies collect, and so we need to remove this amount from the premiums in order to get the true asset management profitability of the company, and correspondingly the expenses also which are there in the P&L. So there'll be a commission attributed to the mortality number, and then there will be benefits paid for the mortality number and the reserving which happens towards the mortality. And the third element is also the OPEX towards the mortality, right? So we exclude these expenses, uh, and after sort of excluding these expenses and amortizing the upfront commission and the OPEX costs, that's the way we can actually determine the true operating profit or true surplus that life insurance companies actually make in this business. So, for example, I mean, we've done that. If you go to page 6 of the note, uh, we carried out all those adjustments, and in the table, we've shown what the adjusted PAT will be of that business, what the surplus and the adjusted PAT of the business will be. Uh, Sham, can you turn to page 6 of the note? In the adjustments, we also sort of, uh, account for the capital employed for this business. So only through the capital employed will we be able to then calculate the ROEs, return on equities, for this business. Sham, go to the table. So this is what I was mentioning. So we carried out these adjustments uh, for us uh, to get, and then now go to page 7. Page 7. Yeah. So the way we look at this business is actually we take the operating profits and compare it to the AUM that these companies manage. And in this case, the linked AUM is what we will look at. So operating profit as bips of AUM, because you need to go a little below percentages. And if you see this, then you'll notice that IPRU and SBI Life are making pretty good margins on their business. SBI Life has improved its profitability from FY17 to FY20. IPRU uh, IPRU uh, IPRU has also improved its profitability from FY15, but it's sort of right now in a way stable between 80 and 90 bips, 93, 94 bips in FY18. So these are the companies where we've seen some improvement. HDFC Life also from over FY17, there has been an improvement, but over the last couple of years, we've seen a little bit of a reduction in operating profits over there. And Max, we are seeing a pretty sharp decline uh, in profitability as a percentage of their AUM. Uh, yeah. Now, I'm just going to talk a little bit about the profitability of asset managers over here. So if you look at the two listed asset managers, HDFC, AMC, and Nippon Asset Management. HDFC AMC makes almost about 41 bips on its AUM as operating profit, and Nippon makes about 27 bips in FY20. And even they have shown a little bit of an improvement in profitability over the past few years. So essentially, asset managers make much lower, the profitability on AUMs is much lower than uh, than life insurers. Um, and there are reasons for that. So there are the few reasons are: one, the mix of assets. So life insurance companies have a lot of equity and debt, which are high yielding assets, and the proportion of that is a lot more than uh, asset management companies, where they'll have asset managers also have liquid and ETFs, which form a much higher percentage of their AUM compared to life insurers. Life insurers will have just long-term money, and long-term money is more yielding money versus what the asset management companies have. Life insurers also charge higher fees on the same AUM. So for debt, the minimum that life insurance companies will charge you will be a percentage of fund management charge on debt schemes. And if you go to mutual funds on debt schemes, You can get direct TERs of 40 basis points also, and even for the larger schemes, you can get something lower than a percentage point in TERs. So so obviously, this is a more expensive proposition as far as the customer is concerned. Also, the duration for which money lies with the life insurance companies is a lot longer. So you have enough time to uh, earn get back the upfront costs that you've incurred to acquire this AUM. So that's a little bit about the profitability of between life insurers and asset managers. Now coming back to why let's say the life insurance companies uh, saw an uptick in profitability.
Hmm.
Now, if you see uh, their expenses, commission and plus OPEX expense as a percentage of the net new money that they've raised, that has actually come down. So this is going to page 9. Uh, so we have Sham, can we go to page 9? 9. Hang on. Okay, so page 8 actually, Sham. This is, I said 9 of the PDF, 8 of the report. Yeah, sorry. So, so if you see, for example, iProve, uh, the the expenses have actually come down sharply. So it was almost 87 basis points uh, on net new money raised, and it's down to 57 and then 19.5. So we know that iPro has not been able to grow its ULIP business over the last couple of years, and they've
Hmm.
taken very actively and pretty drastic measures to reduce their expenses for this business because they don't see growth coming in of there. Max also, FI18 saw that these expenses went up, but 1920 they've sort of reined them in. Now, SBI Life, to my mind, does the best job as far as expenses is concerned because they are consistently lower than uh, lower amongst these four companies. HDFC Life has pretty high expenses. The FY18 number is showing as zero point 0.0 in the graph, but it's actually because it's a not meaningful number. So please ignore that zero point 0.0 point. Uh,
Hmm.
because the denominator was negative, uh, we, the Excel has plotted the graph in this way. So we should just ignore that point. And but the expenses have been high for HDFC Life as well. Uh, yeah, so that's a little bit on the profitability. If we go down to the AUM mix for these
Madhukar,
companies,
before we move to the AUM, just a
yeah,
little
yeah,
question on profitability itself. So,
right.
when we say that 75% is the approximate OPEX and that is amortized across, say, 7 years, which is expected to be the ideal life of a a policy, a product.
Average life of the policies that
Average.
you,
Hmm.
yeah, yeah.
So now, since a lot of stuff has started becoming digital, and there the costs have obviously increased than the traditional ways of acquisition and things like that. Has that made any change there? This is one. And
So
secondly,
1 minute, 1 minute.
sorry.
Can you, I didn't get the question, because a lot of things are digital. What did you ask?
So because a lot of things are digital now, as compared to the previous traditional methods of, acquiring
Yes, yes,
a
yes.
business and processing it. So
Yeah.
has the cost actually at 75 an average today, has it really come down from a higher number earlier? And what do we see going ahead? Do we see this 75% also declining further?
Yeah. So, what will happen is that, uh, uh, see, the costs will go down if there is a lot of digital and direct acquisition of customers. But for most parts, acquisition of customers is still through agents or bank assurance partners, right?
Okay.
Now, if I look at direct acquisition of business, for most companies, it will be, for all companies, in fact, it will be less than 10%
Hmm.
in this business. And so, even though digital is picking up, it does not make that much of a difference, right? Uh, now, if the costs, if the digital costs actually, when you go digital, there are two things that can actually happen. One is companies can keep the gains to themselves, and second is, uh, partly they can pass on the
Hmm.
same to the customers in terms of lower premiums. So, companies follow a mix of these approaches, uh, and some companies will offer you better rates on an online direct buying of a product versus, buying it through an agent or through an insurance partner. Versus some of them will have actually no difference. So how much of the profitability can be retained for each
Hmm.
company will depend on what strategy it chooses to use. As of now, that's not very material because the percentage of sales through the digital platform are not very high.
Okay.
Yeah.
Also, coming to one more aspect where where you mentioned that there is approximately a 3 rupee per thousand of mortality expense, right? Now,
Mortality premium, yeah, that you collect.
mortality premium, sorry.
Yeah.
So, while computing this 3 on 1000 ideally reduces over the span of years, right? As the already invested AUM
Yeah, yeah,
starts to
yeah.
gain, and so this 3 might be 2 in the next year, and then say a 1.5
Good
or
actually.
whatever in the coming years,
It
right?
will
So there should be
it will
ideally an equilibrium which reaches, say, over
it will
3 4 years.
increase because it will
Okay.
increase because as your age increases, the mortality
Hmm.
premium increases. Uh,
Okay.
Having said that, see, this is an average number.
Hmm.
So when you're doing such estimates, you need to use certain averages on a portfolio basis, what the life insurance company would be paying. So
Okay.
that's the basis on which we do this. And
Okay.
as obviously as for a policy holder, or for an insurance company, uh, as the age increases of the policy holder, they will charge him higher for mortality premium.
Okay, but is this not adjusted also with respect to the gains that are coming in the ULIPs?
Yeah,
for
yeah,
the
that
AUM that is
happens.
already in?
Uh, so, uh, so there are two types of ULIP policies that you typically get. One is where the insurance amount stays sort of constant, where the sum assured is, let's say, if the sum what if when you, let's say, if a policyholder dies, he'll get the
Hmm.
fund value plus the sum assured.
Hmm.
And in the second type of ULIP policy, you will get the sum assured if you die. So there, the insurance amount, you'll get sum assured or the fund value, whichever is higher, you will get that.
Okay.
So in the second case, what will happen is that your sum assured, while constant, the mortality premium will keep reducing because your fund value keeps going up.
Hmm.
But most policies are that you get sum assured uh, plus fund value, and they charge mortality premium on the entire sum assured, not on
Okay.
the difference.
All right. So moving to AUM. Uh,
Yeah. So, sorry. Yeah. So this was just to get a sense of wherever the equity AUM is higher, you
hmm.
tend to see that the yields should be higher and the operating profit should also be higher. Uh, so, uh, so while IPRU is where IPRU has the highest equity AUM at 38%, and his profitability is also the highest. But SBI Life, even with a 31% equity mix, is able to do very high numbers in terms of profitability. That's mainly because their expenses are much lower. So their expenses are much lower than the others. And Max and HDFC Life have high equity in their mix, but they also are paying much higher expenses. So that sort of depresses their profitability to a certain extent. Uh, yeah. Uh, Next, I would say that we need to look at the return ratios, what these companies
Hmm.
actually generate. So, asset management companies make much higher return on equity than life insurers, because life insurance companies require very high amounts of solvency capital.
Hmm.
Uh, so just the capital required to do in that business as per regulations is much higher, and that's what is reflected in the next chart, that is on page 9. So, if we see uh, HDFC Life, for example, is just making about 7-8% return on equity, versus an IPRU, which is at about 15 to 16% return on equity, versus actually an SBI Life, which has actually improved significantly from about 10 to 11% return on equity to about 15% return on equity. Max, we see a declining trend because their expenses have actually gone up, uh, and that's hitting their return ratios. So that's now compare this with, let's say, asset management companies. Asset management companies, their return on adjusted return on equities are much higher. So HDFC
Hmm.
AMC almost makes 450% return on equity. So every month, every 100 rupees that is invested in the business, he makes 450 rupees of it every year. So that's the beauty of being a capital light model versus being
Hmm.
a more capital intensive model. And Nippon is at about 100% return on equity. So over there, Nippon actually suffers with higher expenses. So even they have a problem where they tend to pay their expenses, their administration expenses, their employee expenses, their commission expenses are higher than HDFC AMCs. So your return ratio sort of suffers over there. Uh, that is for Nippon. So, but essentially for both these set of companies, life insurers, even the best of class life insurers is making a 16% return on equity versus Nippon, which is not the best of class asset management company, is at about 99% return on equity. So that's a difference in terms of return ratios for these two business models as such. Uh, I think this the second chart on page 9. Sham, if you can just show that. Page 9 of the report. Below that. So the second chart illustrates the point that I was making earlier. So whenever the linked APE of the business grows, you'll see that the reported surplus actually declines. And when the linked APE growth reduces or there's a decline, then at that point in time, your reported surplus actually picks up or grows. And if we just compare the our calculated operating profit, that stays a lot more stable in an amortized sort of accounting way. Your calculated operating profit will stay a lot more stable. So that's what is reflected of here. Yeah.
So, Madhukar, coming to the two top picks that we have, which is SBI Life and secondly MaxF, where we have an ad view.
Yeah.
But SBI Life clearly has its credentials in place where it justifies a strong positive view. Coming to MaxF, while its JV with Axis Bank may provide a sizable distribution network and things like that, it has seen issues such as deal not working out in the past, and it's uh, it's not been able to separate and list Max Life into a different business and things like
Right.
that. So with uh, and of course the promoter holding which is partly pledged. So with these issues, what exactly builds our confidence in MaxF, which as of now hasn't really picked up like its peers have?
So Max is a great operating franchise. So even
Hmm.
in this lockdown period, after April, they've been growing their business at 20% year over year. Right, new business premium is up it last almost at 20% sort of a year over year number. Last month it was up at about 17%, and
Hmm.
prior to that at about 7%. So July I remember was a little soft. August was strong. May, June were again strong. So they're doing a great job at sort of selling their products. They've even in this lockdown period, etc. So that shows the strength of the franchise. Right? They have a good claim settlement ratio. So in and they have a very good product mix. So so the problem with iPro versus uh, how do you differentiate between the four companies? Now, iPro will have a more ULIP heavy product concentration versus Max and HDFC Life, which will have more par and non-par in their product portfolio, right? SBI Life also has a higher ULIP concentration in its product portfolio, but not as high as iPro. And essentially, the more diversified products you have and the more innovative you are in launching products, the more is the better is the durability, or in any sort of interest rate cycle or any sort of market cycle, you will be able to perform better in your insurance sales. So Max gives us that confidence. So on running a business and in terms of product profile, in terms of expense ratios, etc., we're comfortable with Max. The view that we take on the tie-up with Axis is that this tie-up is not going to get dissolved. I don't think that's happening. Max earns for Axis. Max pays on anywhere between 800 to 900 crores of commission every year to Axis Bank. Okay, so Axis Bank is not letting go of Max, and they're fully integrated partners, right? Now, the other thing that you need to look at is in the deal that got announced. First, they were doing an acquisition of and taking the stake up to 30%, but now the deal is at about 18%. So in the deal that got announced, the one very big comfort fact that I get and is the seriousness at which Axis is committed to this deal. So they've said that they'll change the brand. It will become an Axis Max brand. Okay. This essentially means that this becomes a long-term JV. They're not, earlier they had this 10-year sort of arrangements, that 10-year distribution arrangements, and then you had a sale and buyback arrangement of shares. Uh, Axis would buy shares of Max Life at 10 rupees and sell it back to Max Life promoters at 120 or 130 rupees. That was the way of value transfer to Axis Bank, and so that stops. So you get into a clean relationship where you get a long-term distribution partner who's taking equity stake in your business. You're sharing your brand to do that, and you've come out and publicly announced this, right? So and Axis had never announced anything of this sort. Only after getting at least informal approvals from various sources, they have done this. That's our opinion on it. So we expect that 18% this. So earlier also they had announced at 30%. Now they've got it down to 18%. That's principally because RBI has said that you can do the transaction up to 18%. Now we expect that 18% transaction will go through, and this will be a strong sort of business to contend with. Then they've also said that they want to list this business separately. So once you get this approval done, then they will be taking the steps to list Max Life separately, which may entail reverse merger of Max Financial into Max Life, or distribution of Max Life shares to the shareholders of Max Financial, and then ultimate listing of Max Life. So these are the value sort of unlocking chain events which I expect to play out in Max Life. it will take time. It will not be easy. The first leg has already happened. So if you see, the deal was almost announced on 420, 440 levels. The stock, or as soon as that 18% announcement came and the change in deal happened, the stock ran up 10 or 12% on that morning, on that day. So the stock was at almost 530, 540. From there, it closed at all at around 610, 620 levels, right? So it will drift over here at some for some time, and then whenever the final approval from RBI and RDI comes, you'll see the next leg up, and then you'll know of the future sort of course of action in terms of how they get the approval to list Max Life separately. So
Okay.
that is another potential way. So to me, the long-term target for the stock is far higher than my current target price of 645. So it'll come in steps,
Okay.
and it should happen. And it's just that the regulatory regulations take time to sort of go through in these businesses. But just the opportunity for both these companies and how important both these companies are to each other, one has to take that into account. No one's going to let go of this sort of business dynamics that they have going on for themselves. They're making so much
Hmm.
money for their shareholders, each one of them, because of this distribution partnership that they run.
Correct. That's very insightful, Madhukar. Uh, to sum it up, I think we will have to consider MaxF in terms of a long-term investment. Say, for example, from a 5-6 year horizon, so that the whole story and value unlocking plays out. Is my
So
understanding
I
correct?
would say I would say the value unlocking should happen sooner than that. I would say
Okay.
uh, 2.5 years for these triggers to play out. Between 2 to 3 years is what I would say, because I would say that the approval from RBI and IDI for the Axis transaction should come in the next 6 months, and then from there it will take whatever about minimum about 1.5 years to get Max Life listed separately. That's my estimate, and
Okay.
yeah, yeah.
Perfect. Thanks a lot, Madhukar. We have exceeded the time today, but I think this was a very enriching discussion on life insurance. Thanks everyone
Yeah,
for joining this webinar.
thanks for having me. Life insurance is slightly convoluted as a subject, so I hope I hope I did a good job in trying to
This was
explain this
very
out.
informative, Madhukar. Thank you very much for explaining in such detail. It has, I'm sure, helped all of us collectively. Thanks
Thank
again.
you. Thanks. Thanks. That's fine.
Thanks.
Thanks.